Hi, I'm Michael Ruger. I'm the managing partner at Greenbush Financial Group. Today we're going to be going over Roth conversions. Now, when you do a conversion, you're essentially moving money from a pre-tax retirement account over to a Roth retirement account. And while there are a number of benefits associated with making this move, there's also tax liabilities and drawbacks that you have to be aware of before you process the conversions. Now, the biggest benefits are really when you get over to the Roth side, all the accumulation from there is tax deferred and you would draw it out potentially tax-free if you follow all the rules. There's other benefits such as you don't have to take RMDs from Roths, the money passes to your heirs tax-free, but people forget about the drawbacks when they do these conversions, such as there could be a sizable tax bill that shows up when you go to file your taxes because of the taxation associated with these conversions. People don't realize that in the years you do conversions, it increases your taxable income, so you could lose financial aid. You could increase the taxation of your Social Security. It could increase your Medicare premiums. You could lose tax credits and tax deductions. So we're going to go over some scenarios that who does it make sense to do a Roth conversion and who it doesn't. So let's first talk about how these Roth conversions work. So as I mentioned, it's moving money from a pre-tax account over to a Roth account. So if I've got $100,000 in a pre-tax IRA, essentially if I just left it in that IRA, I've got $100,000. Let's say when I go to retire, it's now worth $500,000. So when I pull money out of retirement, I'm gonna have to pay tax on that full $500,000 versus if I take that $100,000 and I convert it over to a Roth IRA and then that $100,000 accumulates to $500,000, I don't pay tax on any of that because it was in a Roth IRA when I take it out of retirement. So that's really the true benefit. Now, while that sounds wonderful, the crux of this is you have to pay tax, income tax, and any amount that you convert from that traditional to the Roth IRA. So in the example that I convert $100,000, I moved $100,000 over to the Roth, I'm under 59 and a half. I don't have to pay the 10% penalty, but I'm still gonna get a 1099-R at the end of the year that says I have to pay tax on that full 100,000, but that 100,000 is sitting over my Roth IRA. I can't use that. I essentially have to have a source of money outside of my IRAs to pay this tax bill that I know that's coming on $100,000. The decision really comes down to a tax bracket game. So essentially, when you do these Roth conversions, the idea is I'm in a lower tax bracket now than I will be when I pull the money out of retirement. That's when Roth conversions start to make sense. If you're in the same situation, let's say I'm in a 25% tax bracket now, I'm probably gonna be in a 25% tax bracket in retirement, then it's almost a coin flip whether the Roth conversion is going to work or not. And then there you have those situations where, let's say I'm in a 30% tax bracket now, but I'll probably be in a 25% tax bracket in retirement. Usually the Roth does not favor those people because I'm just committing the money to a higher tax bracket. Even though I'm getting the tax-free accumulation withdrawal, it doesn't make up for the big tax hit I took, and that money handed over to the government is no longer accumulating returns in my IRA like it would have if I just left it in the traditional IRA account. So where this Roth conversion strategy works really well is when you have these high income earners that have what I call anomaly low tax years. So essentially, if they're used to making $400,000 or $500,000, and all of a sudden the business has a really bad year and they're only going to show like $50,000 worth of income, they're going to look at that and say, I will probably never be in this super low tax bracket ever again. Even in retirement, I'll be in a higher tax bracket. So I might as well convert some of my traditional IRA money over right now, intentionally pay the tax at these lower rates before my income returns to its normal level. But outside of the tax rates of taxes now versus taxes later, these conversions do have other benefits for clients, and one of them being Roth IRAs don't require RMDs, or what's called required minimum distributions. If you have traditional IRAs or pre-tax retirement accounts, now at age 72, they force you to start taking money out of those accounts and paying tax on them. If I have sizable pre-tax retirement accounts, those distributions could be larger and they could make me subject to higher tax rates. So it might be in the interest of those individuals to say, I'm gonna start taking pieces of this traditional IRA each year and moving it over to Roth when my tax rate's lower. And then since it's in the Roth IRA, that money is not subject to those RMDs, and it can continue to accumulate until my heirs eventually inherit it down the road. The other benefit of the Roth is how these assets pass to your beneficiaries. So they just recently changed the inherited IRA rules with the Secure Act that just went through. So now beneficiaries can no longer stretch these pre-tax IRAs over their lifetime. If you inherit a pre-tax retirement account and you're a non-spouse beneficiary, now they're required to take out the full account balance within a 10-year period, which could make them subject to higher tax rates. If instead this money is in a Roth account, even though they still have to distribute that money within that 10-year period, they don't pay any tax on Roth accounts. So they actually get that money distributed tax-free to your heirs. So there used to be a fail-safe with these Roth conversions that they almost gave you a do-over, that if you did a conversion a certain year, you usually had enough time to undo the conversion the following year if you couldn't pay the tax bill or something else negative happened. It was called a recharacterization. But when the new tax rules went through in 2017, they got rid of that safety net. Recharacterizations are no longer allowed. So before, if let's say 2020, I did a Roth conversion and all of a sudden I couldn't pay the tax bill come April, or it jeopardized my financial aid, I had until October 15th of the following year to go back and say, nope, I'm going to recharacterize that money back to my traditional IRA and kind of erase what happened. But with the Tax Cut and Jobs Act, they got rid of that recharacterization feature. So you have to be even more sure that when you do these conversions, that you have a way to pay those taxes and avoid any of those financial or tax pitfalls that might be waiting for you. If you have any questions on these conversions, feel free to reach out to us at moneysmartboard.com. Thank you.